What's up, everybody? We're going back to basics here. Here's the most creative way to eliminate PMI. Here's my strategy to put the minimum down payment and in 6 to 12 months from now, never have mortgage insurance on your loan. So we're going to debunk some myths. I hope you like this. I think it's going to be a great way to utilize low interest rates in this current and upcoming real estate market. So let's take a look right here, right now, what we have going on. So let's say the purchase price of the home that you're looking to purchase is $500,000, right? So $500,000, typically a 20% down payment would come out to $100,000. Now, most people do not want to put a $100,000 or 20% down deposit, right? You want to avoid PMI. I get it. It's one of the goals. However, with this strategy, we're going to change your 20% down to 3% down, which is $15,000. So if you have $15,000, you could purchase this home, income qualifying, obviously, all right? And we literally just saved you a tremendous amount of money out of pocket, $85,000 savings, right? Now, here's the strategy. According to Goldman Sachs says home prices are going to rise 16% in the next 12 months. So that means that if you buy this house today for $500,000, in 12 months from now, you have $500,000 times 16%. That means your home value will go up. That's right. It will go up by $80,000 in 6 to 12 months. So that number then gives you a value in, let's call it 6 to 12 months of $500,000 plus what Goldman Sachs, the smartest investment bank money manager in the world, says, gives you a new value of $580,000. Well, when you first purchased your home, you put the $15,000 down payment or deposit down and took out an initial loan of $485,000. So in your first year in interest, you usually pay more towards your interest due to amortization, which then in a year from now, let's say that loan is $480,000 for argument's sake. So loan at month 10, let's call it. So 10 months after buying your home, let's say your loan is worth $480,000 as a balance. In order to remove PMI, you need an 80% loan to value. So what we do is we take your existing loan of $480,000, divide it by the current valuation after 6 months. That's the requirement. It then gives you an 82.75% loan to value. So that means in this particular case, what you will potentially have to do is pay down your loan to 80% in order to have the PMI removed. And 80% comes out to $464,000 new loan amount. So if your loan amount has to be $464,000 and you have a value of $580,000, you would then have to pay $16,000 towards your mortgage in a one-time payment or at closing. And now you just eliminated PMI for good by putting a total of $15,000 down plus $16,000 one-time principal payment, which in total comes out to $31,000. So in essence, you put a total of 6% down in the course of 12 months and you eliminated PMI. Now, again, to be clear, I want you to understand that if the market doesn't go up that amount, then you will still have PMI, or you can put more money down. But with Goldman Sachs forecast of property values rising, depending on the market demographic that you're in, I see prices potentially even rising higher, again, depending on the market. And this is specifically for one-family homes, maybe two-family homes. It's a little bit more complicated on 3 and 4 family homes, but if you take advantage of this scenario right now, you will literally be able to eliminate PMI in 6 to 12 months with only putting 3% down out of pocket and potentially a couple $1,000s more when your new appraisal is done after month 6 up to month 12. If you have any questions, as always, reach out, jeff@jeffvannote.com. Call me, text me, 551-222-1873. Again, 551-222-1873. This concept, this theory can be applied anywhere in the United States. I highly recommend take advantage of it. With all the market uncertainty coming up, I love everyone to have more money in the bank and put the minimum down for financing your mortgage. Interest rates are expected to rise over the next couple of weeks. However, in the next 6 to 18 months, my belief is that interest rates will drop down to under 2.5% on a 30-year fixed rate. So let's see what happens. As always, I'll run through this scenario with you one more time so you can see. Right now, you have purchase price of $500,000. Whatever that number is, multiply by 3%. This gives you your initial down payment. The bank lends you the difference of $15,000 minus the $500,000, gives you $485,000. If prices rise 16% as expected, this time in 6 to 12 months, your home will be worth $580,000. If your loan at month 10 is only $480,000, then you have to get down to 80% loan to value. Right now, it would be at 82% based on what you owe, based on the current value. So you'd have to pay down additional money to that 80% number. Take the appraised value, multiply it by 80%. That gives you this number right here. So with less than 10% down, less than 7% down on this scenario, you will be able to not have PMI after month 6 all the way up to month 12 for the life of the loan. And most likely your interest rate will be less. So as always, be sure to ask your questions, but make sure you're getting the facts. Experience wins. Get in the game. Deposit that.